Hey everybody, Courtney Smith here with our Wall Street winners for October the 31st. Well, I called the absolute low of this move. I hesitated the next day, but I've been solid bullish ever since. However, this rally is about to shake and bake a little bit. So, and I'm going to show you why. There's a couple of things that are showing some weakening of this bull market. Now, the bull market's in place. The bull market's in place, but this V bottom, that's not unusual. So we could see this market move higher, dip a little bit, and then move higher after that into the real bull market. Let me explain as I go through our various indicators. First of all, the purple predictor on balance volume is very weak. Why is it not as strong as the price action is? It shows that the smart money is not committed to the bull side yet. That's what this is showing. So that makes me a little nervous. I want the smart money to agree with me, or I agree with the smart money, however way you want to think about it. But I want the smart money on my side. I don't want to be fighting him. So that makes me nervous. Another thing that makes me nervous, this is the Dow skyrocketing. This is the leader of the three big indices, and look at this little green line. It's now up above this level, this 70 level. That's relative strength index, or RSI. Very, very strong. The problem is that whenever it gets up to this level, look at what happens. Plungeorama. So I don't like this fact. This tells me that we're within a week or two of some type of a dip here. Another thing that makes me nervous is look at the little green line. That shows that the buying pressure. But look at what happens when we get up to this kind of buying pressure. It's too much. We're going to run out of gas up here. The bulls have taken over. There's no question that the bulls are running this market. And any dip in the market isn't going to be new selling. It's going to be bulls taking the quick profits that they've made from being a subscriber to Wall Street Winners. Just joking on that last part. But the point is, this type of buying pressure is unsustainable. Now, the black line is ADX. That shows that we're in a bull market. It's confirming that we're in a bull market. So there's no question that that's what's happening. But I think we're going to fade a little bit. Now, the NASDAQ still has yet to overcome these highs over here. You can see the purple predictor is also weak here. This is where the weakness is in the NASDAQ, not in the economically sensitive stocks that dominate the Dow. Now, seasonality. I put my trigger line right up here. Could have put it down here, quite frankly. Probably should have. But anyway, we're here. So right here, if we break above this high here on IWM. IWM is the Russell 2000. It's a very broad index, small caps. You can see it's doing pretty well here. If we break above that, then I'm going to start putting on 50 to 100% larger positions, okay? Because if I can get seasonality as part of my tailwind, that means I can make more money. That means I'll have more profitable trades, and the profitable trades I have will be bigger. Utilities, who cares? All right, according to Stock Traders Almanac, we're right here, and notice this little dip here. That's what I think is going to happen. We won't break the lows that we made in October, but we're going to stagger a little bit as we go through November. A little bit too much bullish enthusiasm too quickly is, I guess, all I'm saying. So those bulls are going to take some profits. You can see, where is this bull market coming from? It's coming from the bond market. We talked about this last week. Now, another interesting one is, look at this. This is our risk indicator. And it's an indicator, of course, you are watching this because you want to see what the market's really doing. You want to see unique indicators, not the same old blah, 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 that boring stuff. No, So the risk indicator tells us how much risk does the market want. And typically speaking, bull markets are built on increasing risk. Notice the big bear market here. Even during the summer bull market, it didn't really do much. So you can see, let's call it neutral to ever so slightly bearish. This is also interesting. They're flooding into the stock market. I showed you that. They're coming out of the bond market. They're coming out of cash. They're going into the stock market, but they're still buying conservative stocks. They still like consumer staples more than sexy high tech. I showed you the NASDAQ. Same story. We really, at the beginning of a bull market, people are usually still conservative. And eventually, when they really believe that the bull market's here, then they start reaching for more risk. But right now, they're still not doing that. That's why you can see they're buying the Dow stocks. They're buying stocks, but they just like the old-fashioned, high dividend, strong balance sheet, strong profitability. They're not ready to go into high tech or biotech where earnings might be a little scary. And of course, you've been seeing big tech been beaten on like a drum. They don't like that. Global shares, they're pretty weak. We still want to be in America. We don't want to be in overseas. Yield curve plunging, getting even more and more negative. Of course, we've hammered on this for a long time. We told you about this over a year ago. Bonds got a little bit of a rally. So they took money out of the bond market and put it into stocks, but still bonds rallied. Why? Look at this RSI. I told you about this. It's when it gets down below 30, we get a rally. Gets below 30, we get a rally. Gets below 30, we get a rally. Gets below 30, we get a rally. Am I being redundant here? You're here because you want proven techniques. You don't want a lot of blah, blah, blah. Okay. Our indicators, though, same as last week. But notice this. We see here that the blue line, that's 10-year treasuries in Germany, hooked down, and we may be reaching a high in bond yields, at least for some time. Our two other indicators are in bear markets. And I told you last week, I explained it, but that when we get both of them going in the same direction, which started here in July, it's a 6-month leading indicator. So July, August, September, October, November, so like December, we should start seeing interest rates go down. Now, 6 months, give or take a month, okay? Cut me some slack if it's in November or December, okay? But the point is the combo of commodity prices plus gold is a leading indicator of bonds, okay? That's the point. You heard it here first. This is an indicator that I am the only person who uses in the world. Well, people who work for me, they stole it from me, but that's okay. Dollar under pressure because those yields are coming down. I think the dollar is peaked. I told you this a month ago. You can see over here gold. Wait a minute. If the dollar's under pressure, why is gold under pressure? That just shows you how weak this is. I mean, really. I guess we made it through wedding season and nobody wanted to buy any gold jewelry for their brides in India. I think that's what's going on here. The season's over, so the seasonal bullishness that usually takes place in August and September, it's gone, and now we're into seasonal bearishness and see you later, gold. Gold indicators, though, perked up a little bit. At least we have one that's in a bit of a bull market here. But still, no reason to be in the gold market. Crude oil, staggering. I keep saying we're going to stagger. We're going to go nowhere. I do think, however, we're going to slowly drift lower. So this low is below this low, which is below this low. Now, this low is higher than this one. But you can see we've been in a steady sort of sluggish bear market for quite some time. And I think we're going to continue that way. Demand is going to continue to diminish. We're going to see things like the Biden administration pump out even more oil from the Strategic Petroleum Reserve. And basically politicians around the world are going to do whatever they can to get the price of oil down. So the price of gasoline goes down. So the price of fuel oil goes down. So people don't, so they can drive their cars and heat their houses this winter. That's going to be the big one. Okay, Bitcoin got a little bit of a rally here. Purple predictor's not looking too bad, but really, who cares? Who cares? All right, freebies, you know what to do. Why do I have to nag you? You should just be reaching for your wallet. I want to tell you about a concept that we call extreme profits. I'll tell you what it's generically called in a second, but this is the most powerful risk management tool ever invented. Now, normally I use a technique, and what I teach in most of my courses is a technique called fixed fractional. And I teach that technique for a very simple reason. It's the best balance between a risk and reward, the best balance. But extreme profits, this technique is not about balance. It's about extreme profits. So it's kind of insane, but it does lead, it can, if you do it right, you have to do it right. So there is a caveat there. You have to do it right, and then it becomes the most profitable system ever. Now, this is based on research by John Kelly, who was a Bell Labs scientist, and it was perfected by my friend Ed Thorpe, who was the guy who really popularized card counting in blackjack. And it's called the Kelly formula. You can Google it and you can learn quite a bit about it online. And what the Kelly formula does, though, is it's not designed for this balance between risk and reward. It's designed to maximize profitability. Maximize profitability. So it turns risk management from a defensive weapon into an offensive weapon that you can wield to maximize profitability. Well, it's, nothing is for free. So the bad news with this technique is that there's much higher equity volatility. If you did it the way Kelly and Thorpe used it, you could see your account drop 50% in one day. Now, that's not the way I use it. I've completely modified it so that it's far more relaxed. Still higher equity volatility than I'd normally have and what I normally teach, but much less than the way it's taught by John Kelly, Ed Thorpe, etc. The good news, if done correctly, it can lead to dramatically higher profits. I said a second ago that you could lose 50% in one day. Yeah, but you could also double your account in a day as well. So, as you can see, it's dramatic in both directions, but do it correctly. Now, the Kelly formula was actually invented for as a formula, John Kelly, to how to get more information to go through a copper wire. He worked for Bell Labs, and so they were trying to figure out how to get more information to go through a copper wire. But then guys like Ed Thorpe and other mathematicians came along and realized that it could be used for gambling and it could be used for investing. And Ed Thorpe built a tremendous career as an investor. I wouldn't even say he was all that good of an investor, but he used the Kelly formula better than anybody I've ever seen. So that's what it's all about. Now, hang on. See, I'm going too fast. I'm too excited. So how can you get this? We've put together a course on extreme profits. I used many years ago. I did a course quite often. It was a $5,000 course, and we did it on futures and Forex, and it was incredible. I mean, it was just an incredible course that cost $5,000. Well, what we've done is we've now adapted this for stock traders. This is amazing. Nobody's ever taught anything like this ever. Now, in order to get this, you have to join the Wealth Builder Insider Membership Program. And that's a modestly priced monthly membership program. I'll show you the URL in just a second here, and you can click on it. But you get this course, which we're posting pieces of it every day now, on the website. And you get that, but then you get the most extensive education on stock and option trading in the world. This membership site, well, I'll be frank with you. The problem with it is that there's too much. You get too much. So we even had to add a section on how to actually attack the website, because it's going to teach you asset allocation, stock selection, swing trading, position trading, multiple techniques for stock selection, ETF trading, everything. It's really, quite frankly, a bit overwhelming. So the very first section, which we call the hub, tells you how to attack it in a logical manner, depending on what you're most interested in. And of course, we also have options trading on there as well. And that's all for one low monthly price. This is like getting 10 PhDs for a peanut. So where can you get this? Well, it's pretty simple. You just go to wealthbuilderinsider.com. wealthbuilderinsider.com. You don't need the capitals, but I just made it capital so you can read it easier. But go there, check it out. Remember that what's not on this website here is we've just added our Extreme Profits for Stocks course inside the Wealth Builder Insider. All right, everybody, go there now. I'll see you inside.